During the past week, the National Stock Exchange displayed a mixed trend influenced by both positive and negative factors. The resolution of the gas sector's circular debt and the approval of a refinery policy maintained positive sentiments as noted by RFIB Limited. Pakistan Stock Exchange's benchmark KSE index concluded at 48,424 points, marking a decline of 161 points or 0.3% from the previous week. Negative contributions to this trend originated from the technology, exploration and production, oil marketing companies, refinery and chemical sectors. On the positive side, the fertilizer and banking sectors made significant contributions to the overall performance. Additionally, Pakistan's weight in the MSCI Frontier Markets Index was increased from 0.6% to 2.7%, contributing to the positive atmosphere. However, the State Bank of Pakistan's foreign exchange reserves decreased by $110 million to reach $8 billion. The rupee also depreciated against the dollar, closing at 288.49 after a 0.5% loss compared to the previous week. Pakistan has shared with the IMF a plan for containing gas sector circular debt, estimated to have risen to $1.6 trillion. The proposal involves non-cash adjustments and tariff rationalization. The plan involves injecting about 414 billion rupees into the SUI Northern and SUI Southern gas companies to clear dues with Oil and Gas Development Company Limited, Pakistan Petroleum Limited and Government Holdings Private Limited. In return, the recipient companies would provide approximately 475 billion rupees in dividends to the government. The plan aims to cleanse about 543 billion rupees of the overall gas sector circular debt through these steps. The second part of the plan includes executing the Oil and Gas Regulatory Authority's determinations for a 45 to 50% increase in gas rates. These determinations would generate extra funds for SNGPL and SSGCL. The government had previously committed to the IMF a series of reforms for end-user gas prices, aiming to enhance efficiency and reduce power generation costs. This involves unifying pricing across indigenous gas and imported RLNG, along with implementing structural gas pricing changes. China's consumer prices have fallen for the first time in more than 2 years as slowing spending hampers the economy's post-pandemic recovery. According to figures from the National Bureau of Stats, the Chinese economy slipped into deflation as the consumer price index declined by 0.3% in July after remaining flat the previous month. The price contraction is the latest sign of a darkening outlook for the world's second-largest economy after exports last month fell by 14.5%, the third straight decline and steepest drop in 3 years. China briefly experienced deflation in late 2020 and early 2021 when pork prices collapsed around the country. Deflation is generally viewed negatively by economists as lower prices typically lead to lower consumer spending and reduced production, in turn causing layoffs and salary cuts. China's economy has slowed amid weakening demand at home and overseas after a swift rebound from COVID-19 and tough pandemic curbs at the start of the year. US President Joe Biden issued an executive order aimed at restricting certain American investments in sensitive high-tech areas in China, a move Beijing blasted as being anti-globalization. The long-anticipated rules, expected to be implemented next year, target sectors like semiconductors and artificial intelligence, as Washington seeks to limit access to key technologies. The program is set to prohibit new private equity, venture capital, and joint venture investments in advanced semiconductors and some quantum information technologies in China.